Most people who hold Bitcoin have not built a sovereign financial architecture. They have bought an asset. That distinction matters more than price. Holding Bitcoin on an exchange is not financial sovereignty, it is a preference. A statement of intent that the infrastructure beneath it does not yet support. The asset may be sound, the structure around it is not. This is the primary vulnerability in how most individuals approach financial independence. They focus on what they hold, not on how it is held, where it is held, and what happens to it when the environment changes. They treat custody risk as abstract. They treat counterparty exposure as a detail. They treat jurisdictional concentration as irrelevant until it becomes urgent. Authoritarianism does not announce itself with a single policy event. It advances through layered increments, capital controls introduced as temporary measures, withdrawal limits framed as consumer protections. KYC requirements expanded under anti-money laundering mandates. Exchange operating licenses revoked under regulatory pressure. Each step is individually defensible within its stated rationale. Collectively, they converge on the same structural outcome: reduced exit optionality for the individual. If your financial architecture depends on a third party remaining operational, compliant, and solvent, and on the regulatory environment remaining stable, then your architecture is not sovereign. It is contingent. And contingent structures fail at precisely the moment they are most needed. The question is not whether Bitcoin is a hedge against authoritarianism in theory. The question is whether your specific structure actually functions as one in practice. Sovereignty is not a single decision. It is a layered system, and each layer exists to address a specific category of failure. The first layer is the monetary reserve. Bitcoin held in self-custody, on hardware that you control, with keys that only you possess, functions as a bearer asset outside the counterparty risk framework of the traditional financial system. No custodian can freeze it, no exchange insolvency can zero it, no regulatory action against a third party touches it. The structural purpose of this layer is monetary permanence under adversarial conditions. The risk it mitigates is custodial collapse, regulatory seizure of third-party assets, and exchange failure. These are documented historical events, not theoretical scenarios. FTX, Celsius, MT, GOX. These were not edge cases. They were predictable failure modes of centralized custody under stress. The trade-off this layer introduces is operational responsibility. Self-custody eliminates counterparty risk and introduces personal operational risk. That trade-off must be understood and managed, not ignored. The second layer is the liquidity buffer. Bitcoin is a long-duration reserve asset with high volatility. Treating it as a spending account or emergency fund creates forced selling risk. The scenario where a short-term cash requirement forces you to liquidate a long-term position at the worst possible time. A disciplined liquidity layer, cash or cash equivalent holdings sufficient to cover 6 to 12 months of operational expenses, separates your reserve from your spending behavior. The structural purpose of this layer is drawdown protection, not from Bitcoin's price, but from your own behavior under pressure. The trade-off is opportunity cost. Cash held in fiat depreciates in real terms under inflationary monetary regimes. That cost is real. It is also the price of optionality. The third layer is jurisdictional awareness. A single jurisdiction financial structure concentrates regulatory risk in a single point of failure. If your assets, your exchange accounts, your bank, and your legal identity are all subject to the authority of a single government, a policy change in that jurisdiction can simultaneously affect every layer of your financial life. This does not require immediate relocation or complex offshore structures. It requires understanding where your exposure is concentrated and what the failure mode looks like if the regulatory environment shifts. Jurisdictional optionality is not about evading law. It is about structural redundancy, the same principle that makes distributed systems more resilient than centralized ones. If one node fails, the system continues to function. The trade-off this layer introduces is complexity and compliance overhead. These costs are real. They are also lower than the cost of having all exit routes closed simultaneously. Structure without discipline degrades. The framework you build is only as durable as the behavioral patterns that maintain it over time. The first common failure is position concentration through emotional conviction. Individuals who hold high conviction in Bitcoin's long-term value frequently allocate beyond their actual volatility tolerance, not based on a structured risk framework, but based on narrative confidence. When Bitcoin experiences 60 to 80% drawdowns, which it has done multiple times in its history, conviction that was not stress-tested against real position sizing becomes panic, and panic produces forced selling at the bottom. The structural correction is not lower conviction. It is honest position sizing, allocating only what you can hold through a full drawdown cycle without compromising your liquidity layer or altering your behavioral stability. The second common failure is information opacity. Individuals building sovereign financial architecture frequently discuss their holdings, their custody setup, and their transaction history across channels that carry no operational security guarantees. This is not a paranoid concern, it is a practical one. Knowledge of your holdings creates social engineering vectors. Knowledge of your custody setup creates physical security risk. The structural correction is information minimization. Your holdings are operational data, not social currency. Treat them accordingly. The third common failure is counterparty accumulation, the gradual re-centralization of a structure that was designed to be distributed. Over time, convenience pulls individuals back towards centralized services, yield platforms, lending protocols, exchange-based staking, custodial wallets with better UX. Each individual decision appears reasonable. The cumulative result is a structure that has reintroduced the counterparty exposure it was designed to eliminate. The structural correction is periodic architecture review, an honest accounting of where your assets actually reside and what counterparty risks have re-entered the system through convenience-driven decisions. No structure eliminates risk. The goal is to remain functional when specific failure scenarios materialize. The first failure scenario is exchange collapse under stress conditions. Multiple major exchanges have failed, some through fraud, some through mismanagement, some through regulatory action. In each case, assets held on those platforms became subject to bankruptcy proceedings, withdrawal freezes, or total loss. The structural safeguard is not trust in exchange reputation or regulatory assurance. It is the physical removal of assets from custodial environments where they are not legally yours until withdrawal. On an exchange, you hold a claim. In self-custody, you hold the asset. That distinction is the entire architecture of counterparty risk. The second failure scenario is regulatory shift under jurisdictional pressure. Governments facing fiscal stress have historically expanded the scope of financial surveillance and control. Capital controls, mandatory reporting thresholds, restrictions on foreign asset holdings, and in some cases, forced asset repatriation. The pattern is consistent across different jurisdictions and different eras. The structural response to this risk is not prediction, it is preparation. Knowing which of your assets are visible to which jurisdictions, which are subject to mandatory reporting, and which exist in bearer form outside those frameworks. This allows you to understand your actual exposure, rather than your assumed exposure. The structural safeguard principle that ties these scenarios together is this: the value of a sovereign financial architecture is not measured when conditions are stable. It is measured when conditions are not. Build for the stress test, not for the calm. Sovereignty is not purchased in a single transaction. It is constructed incrementally, layer by layer, under discipline sustained over time. The individuals who will benefit most from decentralized monetary infrastructure are not those who bought the asset earliest. They are those who built the architecture most deliberately, who separated their reserve from their liquidity, their self-custody from their exchange exposure, their jurisdictional optionality from their jurisdictional concentration. Bitcoin as a hedge against authoritarianism is not a passive position. It is an active structure. The hedge only functions if the asset is held in a form that authoritarian pressure cannot reach. That requires custody discipline. It requires liquidity layering. It requires behavioral stability under drawdown. It requires periodic architecture review to ensure that convenience has not silently reintroduced the counterparty exposure you spent time eliminating. The monetary environment is not going to wait for you to build your structure. Regulatory frameworks are being written now. CBDC infrastructure is being deployed now. Capital control precedents are being established now. The architecture you build under calm conditions is the architecture you will depend on under stressed ones. You do not need to predict the exact form of the risk to prepare for its structural category. You need to understand where you are exposed, reduce the exposures that are unnecessary, and maintain the discipline to hold the structure you built when the pressure to abandon it is highest. That is the operational definition of financial sovereignty. This is 21 Protocol. Freedom is not a feeling, it's a structure. If you don't build yours, they will build over you.